Hello and welcome to the stock specific class here for Thursday, December the 10th. We're going to go over some individual stocks that I like, and then the topic or the training for today is we're going to build on what I covered in the later part of the class on Tuesday. I talked about the stair step and looking at how to start to read trends and read charts. We're going to build on that by talking about Fibonacci retracements, and I'll explain what Fibonacci retracements are. I'll show you how to use the Fibonacci Retracement Tool that's here on Traderspro, the software, and how you can include it in different ways you can include it into your analysis. Before I do that, though, I'll do a quick market update and do the stock-specific stuff. And then those that want to stick around for the training, you can do that. Class will be anywhere from about 45 minutes to an hour or so. And again, for those, the training is really geared towards people that don't really know how, or just getting started, may not know how to feel comfortable how to read a chart. And so if you've got a lot of training experience, at least some of this early stuff that we'll be doing, I don't know how much you'll want to stick around for, but that's why I'm doing it in the later part of the class, so that you can eject out if you feel like it's too basic for you. But hopefully it helps those that are just getting started to better use not only become better traders, but are able to better use the software as well. Now, as far as the overall market, we had a little bit of a slide yesterday, and I've talked about this for the last couple updates that the market is showing some signs that it could sell off a little bit. I still don't think it's in a position where it's going to crash or have a major drop. I'm not seeing any signals of that or any warnings of that just yet. And these little one-day sell-offs and things like that are tough to. It's tough to see them ahead of time. They can come out of nowhere. A lot of times they're related to news of the day, and unless you can know the news of the day ahead of time, which many times you can't, especially unexpected news, it's hard to prepare for some of those. I was getting a little concerned near the end of the day, and we'll take a look at it when we look at the QQQ chart, but it was starting to surge a little bit into the close, the selling, and that always worries me. It wasn't surprising that we opened lower today. In fact, I was hoping that we would gap down and then that buyers would start to push things back up, and that's exactly what happened. So we'll look at those charts here in just a second. But while we're on the direction alerts here, you can see that we're moving more and more off of the overbought condition, which is good because it means if buyers do come back in, that the trend can continue. And so the momentum has moved down. Well, we were already in the buy zone here, but we moved even further to the left with yesterday's sell-off. Breadth indicator was an extreme, and we moved into the high area there. And then sentiment was also in the high area there, but we shifted a little bit to the left on that one. Despite the selling yesterday, the buy-sell ratios we're still in a kind of an extreme level between the buys and the sells. And that could be expected because a one-day sell-off like that, what's going to happen is you're going to see buys go into holds. Remember, it goes buy, hold, sell. So that's why we're not seeing any increase in or decrease in sells, the sell indicators, but we are seeing the buys dip down, and that's just those going to hold. If the selling continues, and if we start to see a few more days of selling, you'll start to see more stocks go from hold to sell, and you'll start to see this red line tick up right here, which it needs to do eventually. But we've you can stay elevated like this for a little while, and that's so it's not that we know that we're still in a little bit overbought condition, but it's possible that we can still see it kind of grind a little bit higher for a little bit longer. So we'll see if that continues. And usually we'll see other warning signs. This is one warning sign that's saying that, hey, we could be due for a pullback. Usually what will happen is you'll start to see 2 or 3 other ones as well. The VIX starting to spike up and things like that, or price action on the individual trading day for the indexes that can show that that we need to be a little bit more worried. But like I said, with the gap down today, and then we've rallied back up off of that, that's an indication that we don't need to be overly concerned just yet. Now that could change, but as of right now, I'd say that we're still looking okay. From a sentiment standpoint, we're not in the extreme area yet. We're not up here. We are elevated. You know, we've come off of these lower levels, but if we grind higher, we could see this start to move up. And if we start to see this get into that extreme area, this is one of the other things that I would look at. Buy-sell ratio is wide, and you start to see the sentiment indicator here getting into that extreme range. Then you know you're getting real close for a decent-sized pullback. So, all right, let's take a look at the chart. The S&P here. Now, the S&P didn't have a big down day. The Qs yesterday were the ones that were worrying me. If we pull that chart up here, you can see it had a much bigger drop. Now, what was interesting at the close was that we were below this previous high right here. Let's see if I can draw a straight line. Yeah, close enough. We were below that previous high right back here, but here's the other support area. We were above it. And so we're kind of in no man's land. And so what I was hoping for, which was what happened today, is that we gapped down. We opened right at that support area right here. So right, these previous highs right here, we opened in that area there, and then we've moved up now, so we're higher than where we opened. That's a good bullish reversal. But we're also right back at this previous high right here. And I have a feeling we're just going to be stuck there. Now, if we surge above that by the end of the market day, that's going to be really bullish. That's going to be good because we'll be breaking out again. But the way it's just sat there pretty much all day. It's just sat below that resistance area. So we'll see if it just holds right there. I don't mind it holding right there. I don't mind it just staying right there. What I don't want to see is I don't want to see it fade into the close. If we start moving back down to the lows of the day, back down to the support area, that's not going to be good. And we are off the highs a little bit, but not too bad. We'll see. And again, if it kind of looks like it does right now, or if it can break out of that resistance area, that'll be pretty bullish. If it fades back down into the close, that's going to be pretty bearish. I'd be a little bit worried about Friday. And if we break this support, it could be that we're in for a bigger correction. Trying to show you. It could be like something like this where we drop for a couple weeks or so. But we need this area to hold to prevent that. All right. And the VIX has been, the VIX moved up. Let's take the volume bars off here for a second. The VIX moved up a little bit yesterday, but it wasn't really spiking. Like it wasn't really showing huge fear. Now remember, this is a good lesson here when you're looking at the VIX. I have to remind myself of this sometimes from time to time. The VIX is always related to the S&P 500 because it is reflecting changes in the implied volatility of the S&P 500 index options. Now, you don't need to understand how that works or anything. All you really understand with the VIX is usually if the market goes down, the VIX spikes up. if the VIX, if the market goes up, the VIX usually is going down. It usually will move opposite of the market. And when it moves in the same direction as the market, you want to pay attention. The VIX is also often referred to as a fear indicator. It's telling you, I changed that definition though. I like my definition a little bit better. The VIX tells you the level of freaking out of the institutional traders, the big professional traders, the level of freaking out of the big institutional traders. Now, why is that important? Well, what we're reading in the VIX is we're reading what professional traders are doing. Are they hedging or are they not hedging? Are they buying protective puts to hedge against a drop, or are they not? If they're not, it means they're not worried about a drop. And so if you have a down day in the market, but the VIX doesn't go up very much, it usually means, or it goes down, it means that the professional traders aren't too worried about that drop. They don't see it as being a threat. They don't feel like they've got to hedge or buy that protection, buy that insurance to protect their positions. Now, the opposite could be true. The market could be going up, but the VIX is going up. Well, that could tell me that those big institutional traders are still buying. That's why the market's going up. But they're also buying protective puts because they don't trust the rally. They're not quite sure the rally's going to keep going, and they want to make sure they don't get burned buying in right there. So those little subtle things, subtle movement of the VIX sometimes can warn you of things to come. So if we now, and the reason why I point that out in relation to the S&P 500 is the big drop yesterday was on the NASDAQ, okay, and particularly the NASDAQ 100. The S&P wasn't down that much as compared to the NASDAQ. So that's why the VIX really didn't spike too much, is because it was, the S&P didn't really drop in as big a way. So if you're sitting there saying, "Well, I don't know what's going on. The NASDAQ is dropping like crazy, but the VIX really isn't spiking." Well, that's because it's apples and oranges. It's not looking. The VIX is not looking at the NASDAQ options. It's looking at the S&P index options. All right. So, and usually, a lot of times you're going to get mixed moves, meaning and it's happened a lot lately, where you'll get the NASDAQ up big for the day, but the Dow will be down. And it's usually the Dow. It's usually the Dow and the NASDAQ moving oppositely in the S&P, because it has both stocks in it in a pretty big way. It'll kind of be in the middle. In other words, you could have a day where the NASDAQ is up a big amount, up 100 points, but the Dow is down 100 points, and the S&P is up slightly or down slightly. It's kind of in the middle. And so that's why we like to look at the S&P 500, because it's a better indication of the broad market. It's not focused just on tech, and it's not focused just on everything else. The Dow's a little bit more narrow. And so now a real healthy market is when they're all moving strongly in the same direction. You have the Dow up 1%, the NASDAQ's up 1%, the S&P 500's up 1%. You have a pretty solid move. But we've seen a lot of fractal movements where one's been up and the other's been down. That's usually, what's that usually is telling you is that money is just rotating around in the market. It's coming out of one area and going into the other, and it's not really. It usually isn't a healthy sign. And so that's one clue that we can notice too, is we start to see mixed markets, is what we call it, when they're moving in opposite direction. We start to see a lot of that, and we have seen quite a bit of it over the last couple of weeks. And so we are making a mental note of that, but we're not quite there yet, where we start to see mixed markets, and we start to see that sentiment indicator at the extreme, and the buy-sell ratios still the extreme, and the VIX moving up and the markets moving up. And those are all a lot of red flags that we're about to get hit and about to drop. If I see it, I'll definitely be pointing it out so that you'll be able to see it too or be aware of it. All right. So let's take a look at some individual stocks. Now I'm going to start off in computer technology, but I'm not going to pick a stock in computer technology. But I saw a good example that tied into what I was teaching about the stair step and the impulsive and corrective moves that I taught you on Tuesday. And again, if you want to go back, you can go back in the recording on that and review it. If you missed it on Tuesday, there's a lot of good information there if you're a newer trader. But the only 98 strength rank is this. Actually, I could have pointed this one. I still like this one, CBAT, but we've already gone over it a couple of times in different updates. I didn't want to cover it again. The one I want to talk about is this NCTY right here. Now, it's only a 96 strength rank, and it's a $3 stock, but it's a good example of how if you can combine the software with just some basic chart analysis, you might be able to know which of these are really good opportunities and which ones you might want to avoid just based off the price action and the chart pattern. But NCTY, I pulled this one up, and you say, well, boy, this stock's in a nice little uptrend here, and it's pulled back a little bit. Now, let's put the signals on here too for a second. It's pulled back a little bit to a hold signal, and it's very close to going back to a buy signal. Why don't I like this? Well, remember what we learned on Tuesday, which was that stocks tend to alternate between what we call impulsive and corrective moves. And a gap like this is considered an impulsive move. Obviously, it didn't trade several days up there. It just moved up there in one day. But this would be an impulsive move up to that gap up point right there. And then you have this sideways choppy. This is a corrective move. That was followed by an impulsive move. Now, one of the things I taught you on Tuesday is very often when you get a trend reversal, one of the signs of a possible trend reversal is that you'll get back-to-back impulsive moves in the opposite direction. And what I saw when as soon as this chart pulled up this chart was I see an impulsive move up, and then I see an impulsive move down. And then what happens is you'll start back into that alternation again. So now we have an impulsive move down, and now we're moving corrective, moving more choppy, more sideways. Now, I don't, it's possible the stock goes right back up again. I don't know exactly what the stock is going to do, but based on probabilities and based on the way stocks typically behave, the next move on this should be down. One of the other things I talk about a lot, I talked about on Tuesday as well, is whenever you see a stock moving sideways, you want to pay attention to the direction it was trending in or moving in before it moved sideways. That's where it's more likely to go after it's done moving sideways. And definitely there was an impulsive move down or a trending move down before that sideways move. So the probability would be that this has at least another move down, that it has at least one more move down. And I would assume that if this is just a pause within this larger uptrend, that it would come down into this support area right here. And then who knows, maybe it can find enough strength to start to reverse and go back up again. By the way, if this did sell off, what could be a signal to me that it's done pulling back and it's ready to start going back up again? Well, if it sold off real fast and had an impulsive move down, and then suddenly you get an impulsive move up, and then it starts moving sideways again, and it has that corrective move, there'd be a really good chance that thing is going to take off again and move up again. How far could it move up again? Well, then it looks like an inverse head and shoulders pattern if it were to do that. And we've seen a lot of those in these updates when we're looking at individual stocks. I pointed out inverse head and shoulders patterns before, and I'll continue to do it when I see them. And what do we know about inverse head and shoulders patterns? If they break out above that neckline right here, they have a tendency to move up about the same distance between the the neckline and the head, top to the bottom of the head in this case. So you take that distance there and project that upward. That lines up pretty close to the previous high right there. So you'd say, boy, that has a good chance to at least get back up to that previous high. Now I'm just drawing this all out, but hopefully you see that when you get all this stuff down, and you will. I didn't know this stuff. I wasn't bored knowing this stuff. I just worked at it. And then pretty soon you learn to recognize it, and then it just jumps out at you. But you see how it knowing all of this might help me to not buy in right here, because I recognize impulsive up, impulsive down, corrective. We should have another impulsive move down based on the probability. But also, if that does happen, I can learn how to recognize when to get back in. You get a impulsive move down, impulsive move up, and then it goes corrective. That's a sign of a bullish reversal, plus the inverse head and shoulders pattern is a bullish pattern. And then if I get in and it breaks out above that neckline, I know where to get out, because the rule of thumb is it will tend to go up about that same distance as the base of the head to the neckline projected upward there. And so these are all things that can make you a really good trader if you can get, but don't, and again, if you're really new at this, don't freak out with what I'm saying. Just try to digest it one little thing at a time. Take one thing that I go over one class and work on that for a month or something. You know? That's why they're all recorded. You can go back and review them, but you're not going to be able to cram all this in and know it all instantly. It's going to take a little bit of time, but I just wanted to just illustrate that it's worth your while to do it, that you put in that work to learn it, and it'll make you such a much better trader once you get it down. But that's why I didn't like this stock right here. I didn't like it. All right. I kind of got into the training, but I got to get back to the stocks, and then we'll get to the training. But I just thought I saw that today. And I thought that was a good tie-in to what we learned about on Tuesday. All right, so let's go into the sectors here and go to retail. Again, one I've talked about a number of times that I like. It's only a 94 strength rank, but I like the pattern on Big 5, BGFV. And we're still kind of waiting for this to kind of go back to that buy signal. Though this is going to tie into our topic for today. I'll come back to this chart and tell you why I think the stock is very close to starting to move back up to go back to that buy signal. But this is one that I liked. I like the nice upward trend on that one. Higher highs, higher lows. All right, let's go into the basic materials sector here under the holds. I like this DQ right here. It's a 97 strength rank. I've brought this one up before, and that's because it's been kind of moving sideways. It hasn't really started taking off yet, but you know, here's your impulsive move up right here, and then since then it's just been kind of chopping sideways right through here. Now it could chop sideways for a little while longer. In fact, I think we brought this up back in here at some point, and it still is kind of moving sideways. You could either wait for a buy signal or wait for it to break out above this range right here. If it breaks out above this range, it'll really start taking off. And you know, why could that be important? Well, this thing went back to a buy signal right here, but it's still stuck in this range. So if you want just to not have to worry about it moving sideways, just keep kind of checking on it and wait until it breaks out, and that thing should start to run on you. But that one's a nice pattern there that I've mentioned before. Another one in this group, basic materials, is 99 strength rank, this GRWG. So this is a good example of when I said, whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. There was a trend. That's the direction it should go after it's done moving sideways. Well, after it's done moving sideways is quite a while. This thing moved sideways for what, 4 months or so, 3 months, 3 months there before it finally broke out. And then once it broke out, then it took off. But there's your impulsive move right there. And then it's pulled back a little bit. Looks like a little bit of an ABC pattern. I'll teach ABC patterns in another class. But it pulled back in here. It's gone to a hold signal. Could it drop a little bit further? Yeah, it had a nice little bullish reversal today. Just like the rest of the market, it opened up lower down here, but it's trading higher than where it opened after dropping a little bit yesterday. So again, if this thing could go back to a buy signal, this thing could continue to run. If not, if it keeps dropping, if it reverses this reversal, pulls back a little bit further, then you're not in it because you didn't get the confirmation to get in it. And then one more off of this sector, we'll look at this real small company here, ZENYF. ZENYF. Now, I'm not usually a big fan of stocks that are under $10. Usually my philosophy is they're cheap for a reason. They're cheap because they're usually not very good companies, and sometimes you can get into those. You have the big greed in your eyes of those stocks going from $10 to $700 or something like that. But a lot of them, a majority of them, don't go anywhere. That's why they're a $10 stock. And so I'm usually not a big fan of stocks under $10, but every now and then, you can see stocks that are moving, and as long as there's a good trend there, then I don't have a problem with trading some of these. And you could look at their liquidity though, like this one. I don't even know if this one looks like it trades. It's on the OTC, so it might be one of those pink sheet stocks that you may not even be listed with your broker you're trading with. So, but if it is, I like the pattern here where you've got a nice little sideways move right through here, nice little breakout move over here, and waiting for this thing to go back to buy and see if it starts to take off again. The reason why I might be more inclined to trade some of these is that we're in a hyper bullish environment, and there's a lot of retail traders out there, the Robinhood traders, the millennials that are getting in the market. They're basically gambling in the market right now, but they like to look for cheap stocks. They don't care what they do. They just like them cheap, where they can buy a lot of shares. And it could be one of the reasons why a stock like this is up so much and possibly could keep going. And it usually doesn't end well in these type of market environments like that when it's hyper bullish. But sometimes you can have some pretty nice rides along the way before the music stops and everyone starts looking for a chair. All right, let's go into construction. And I like this BXC, Blue Links Holdings. And the reason why I like this, it looks like a cup with handle formation. Here's your cup. Here's your handle. And these are much like those inverse head and shoulders patterns. If it can break out above the top of the cup, it'll usually go up about the same distance as the top of the cup to the bottom of the cup. And so this could be getting ready to run, especially now that it looks like you're forming it. Whenever you can see a distinct handle on a cup with handle pattern, usually you're pretty close to the thing breaking out. So the last confirmation could be either you wait for this to go to a buy signal, which should happen here pretty quick. If it starts to move up, you can see up here, we're pretty close to the buy signal, not too much further to get to that buy signal. Or you could wait for it to break out above that top of the cup right there. But I really like this one right here. This is a nice pattern. By far my favorite pattern to trade is the cup with handle or inverse head and shoulders pattern. Man, those things work almost every time. But not every time. So you can't be putting everything you own in those, risking everything, assuming that it's got to work out. Let's go to industrial products and look at this TPIC. 91 strength rank, but there aren't a lot of stocks in the 98 strength rank. There weren't any there to go off of. But again, nice pattern. Impulsive, corrective, impulsive. This looks corrective right here, kind of moving sideways here. Could it drop a little bit further here in the near term, come down here again to support, then go up? Yep, that's possible. But we're waiting for it to go back to that buy signal anyway, and this one's wouldn't take too much to get to that buy signal, but if it started to move up again, it could be pretty close. You could wait for it to break out too. I like that pattern there. And then lastly, a couple into the autos. Auto tires and trucks here under the holds. I really like, it's a 99 strength rank, but that's fine. I like the pattern on Workhorse, WKHS. Now, I thought this was going to end up being a cup with handle pattern over here. It looked like it was maybe, I was kind of waiting for it to kind of form that handle back and forth up through here, but it didn't. It had I think it had an earning announcement here where it dropped, or I can't remember if earnings or it was just I think this might have just been the whole electric vehicle stocks dropped, and this one dropped with it. But now it's looking to be like an inverse head and shoulders pattern with it dipping down a little bit right here. I do think that this is a critical low right here. I wouldn't want it to go any lower than that. But since we're waiting for confirmation anyway, waiting for this to go back to a buy signal, I don't think that matters that much, because if it does drift lower, goes below there, I'm not in it anyway, so I don't care. But that has the potential to be an inverse head and shoulders pattern. If it starts taking off right here, it starts moving again. A little ways away from that buy signal, which is probably good because you'd want it to move up a little bit to give you that confirmation. I like that pattern there. And then lastly, under autos, tires, and trucks, I liked this FUV 99 strength rank. And again, a long sideways consolidation, broke out of it. It's pulled back again. Had a nice little up day a couple days ago. We put the volume bars back on. Volume was really high on that day. Volume was really high on these when it broke out right here. And so, again, you'd want this to go back to a buy signal. And it's probably pretty close. Yeah, it's pretty close to going back. Down a little bit today, but again, it opened like the rest of the market, opened lower. It's trading higher than where it opened. That's a bullish reversal price action. You can't see it with let me switch the signals off. See it on the candlesticks here. Here's where it opened down here. Here's where it's trading. It's higher than where it opened, but it's still lower than the day before. That's a pretty good bullish reversal day right there. So that's a pretty good sign. Volume's really light though today, so I don't know. I trust the bullish reversal as much. I'd like to see a little bit more volume, a little bit heavier volume than that. But all right, we'll talk about volume in another trading. All right, so I'm done with the individual stocks. Let's go into the trading. Now, I don't want to spend too much time getting into the background of Fibonacci ratios. especially since you can Google Fibonacci ratios and you can spend as much time as you want going over the background. I really want to show you how to apply them. The bottom line is that these ratios show up all over the place. They show up in nature. They show up in the human body. They're I don't know why they're significant. Nobody really knows why they're significant, but they are. They're tied into proportion, and the best way I can explain that is that what makes a good picture a good picture. If I take the picture, it's not going to have good proportion. I'm gonna if I take a picture, I'm going to leave the top of the heads off somehow, or if you're taking a picture of a Christmas tree in the background, I'd probably cut off half the Christmas tree. It wouldn't look right. But if you look at a really good trained photographer, what they're really good at, when you say someone's a good photographer, what they're really good at is getting the right proportion. They see a balance, and you don't need to be an expert to recognize that balance. You could look at something and say I could show you a picture that I took, and I could show you a picture that a professional took, and say which is the better picture, and you'd say, oh, this one is. And you might not even be able to point out exactly why. Leaving obviously the cutting off half the head would be an obvious thing, but you could tell just because you don't know why it looks better, but it looks better. And if the professional were to tell you why it was better, he would talk about proportion. He would talk about how things are balanced. And I know this sounds like a lot of hocus pocus, and believe me, it took me a while to buy into some of the stuff because it sounded like fortune telling stuff. But there's something to it. That's all I can really say. And I don't base my entire decision on Fibonacci analysis. You can if you want, but I have a more balanced approach. So speaking of balance, I like to look at a lot of different things, and I don't expect exactness out of the market. I think that's what gets people into trouble. They want to know exactly what a stock is going to do, and so they look for exact things that because they believe that if they find that exact thing, it's going to tell them exactly what the stock is going to do. I believe in probabilities, and that's really what good traders focus on, is probabilities. Are there enough things that I'm seeing that tell me that stock should go up or should go down? And then it's beyond that. You got to manage the trade properly. You got to make sure you don't risk too much, and that you have a potential to make more money if you're right than you lose if you're wrong. All these things factor into the process. But there's something to these ratios. And the ones that we're really going to be focused on are 382, which is basically 38.2%. 50%, or 0.450, which obviously is 50%. And 618, which is 61.8%. Now, before I go any further, I need to talk about the main concept of the retracement. The main concept of the retracement is that stocks will tend to retrace about 50% of their moves. It's kind of a 2 steps forward, 1 step back, 2 steps forward, 1 step back. By the way, to tie this into last week, doesn't that seem very familiar to the stair step? 2 steps forward, 1 step back, 2 steps forward, 1 step back. Approximately. I didn't have the proper proportion on that one there, but so the main concept is that stocks will tend to retrace about 50% of the moves. Now, because stocks don't move in an exact fashion, I don't want you to assume that go out there and say, okay, every stock I'm looking at is going to go up $10 and then pull back $5 and then go up $10. No, nothing moves exactly like that. So we need to have a little bit of leeway for these charts. So what I like to call it is we need a zone or an area. You know, I played baseball growing up, so there's a strike zone. Okay, everything inside the strike zone is a strike. Anything outside the strike zone is a ball. I want to know what that strike zone was very important as a hitter in baseball. I needed to know very quickly when that pitcher threw the ball whether that ball looked like it was out of that strike zone or in it. But we're going to look at more of a zone or an area. And so if I say that stocks will tend to retrace about 50% of their moves, that's kind of the concept. I want to widen that a little bit and say that they should at least retrace at least 38.2% of the move, which would be a shallower retracement, and really not more than 61.8% of the move. And that gives you your zone, your retracement zone. Now, how is that going to be helpful to me? Well, as you're going to see, it's very often stocks will pull back exactly to that 50% area and then take off again, or exactly to that 618 area and take off again. Now, remember, I'm not looking for exactness, but it's freaky. Now, I don't base a lot of my decisions. You could, if you start a stock pull back to that 50% retracement, you could just go buy the stock right there, assuming it's going to turn around and go back up again. There are traders that do that. They trade. They are fanatics with Fibonacci ratios, and they use them with their trade decisions, getting in, getting out. I'm going to get in right at that 50% retracement level, and they have a trade management plan around that to manage that. Now, I don't do that personally. I use it more of a general way, but if you really want to become fanatical about that, you can be my guest. So we're looking for this zone. What I like about the zone is that it lets me know when I'm waiting to get into a stock and it's pulling back, it lets me know where I think it could stop pulling back and where it should stop pulling back. And then I want to see it start showing me that it's going back up again. And once it shows me, I like that confirmation. So once it shows me it's going back up again, then I want to get in. Okay. Now, another important thing to consider is, again, don't get caught up in exactness. Could a stock drop below that 618 retracement level and still end up going higher? Absolutely. But if it drops below that 618 retracement level, it usually tells me that stock might be in a trend reversal. So you have a stock that moves up and then retraces 50%, moves up, retraces 50%, moves up, and then it goes below the 618 retracement level. It's not below the previous low yet. It hasn't retraced 100% yet. And by the way, what we're looking at is the retracement of the trend, of the impulsive move. So here was the end of the last step. Here was the impulsive move. Here's the new step, possible new step right here. I'm looking at how far this pullback is retracing this trend move right here, this impulsive move right here. So here's the beginning of this impulsive move. Here's the end of this impulsive move. It's coming down, but it goes below that 618 retracement level, or 61.8%. It retraces more than 61.8%. What does that mean? Well, it's possible it just had a deep retracement and goes right back up again. But from a probability standpoint, if it dropped below that 618 retracement level, then what I might be dealing with is a trend reversal. And instead of this being a step for another move higher, that actually we are now reversing trend, and maybe I'm about to get a little step up right here. Now we're in a downward stair step. Okay. All right. So let's apply this here. Let's apply this right to this stock on FUV right here. Now, first of all, this looks like a retracement right here. A retracement of what? What's it retracing? Well, it's retracing this move up right here. So I'm going to go back to where that move up started. It started right here. See, it was declining right down in here. So this is where it started that move up. Here's the top of that move right here. And this is the retracement right here of that trend. Now, to use the retracement tool, you're going to first put the Fibonacci, turn the Fibonacci tool on, which is this little tab right here. Now, when you first turn it on, you might say, "Oh, it automatically did it for me." That's not entirely true. Sometimes it could be true, but it's not true in this case. Why? All this tool is designed to do is to find the highest point it can see on the chart that it's looking at right now. So right here, and the lowest point. The lowest point was down here, and then draw in the retracements of that. That's not what I'm measuring. I'm measuring the retracement of this move right here. This is where it started. This is the retracement of that move. So how do I get it to fit that, to measure that? What you need to use is this little selection tool right here. Now, have you ever highlighted something, to copy and paste it or something like that with your mouse? Things are changing now where you don't have to necessarily. People don't use mouses anymore, but you know what? If I wanted to highlight a sentence, I'd left click at the beginning of the sentence. I'd drag across, and it's highlighting the whole sentence, and then I'd let go and it would highlight it, right? You've done that before, I'm assuming. If not, you might have to find someone to help you learn how to highlight something. But it works the same way. I'm going to turn the selection tool on, and what I want to do is I want to highlight the area that's pertinent to my measurement, which means that I want to start it a little bit before this low right here, because that was the low point, and I want to end it, in this case, all the way to the right, all the way to the end of the chart right here, because I want to make sure it at least gets that low in there, because that's going to tell me how far that thing retraced to. So I'm going to basically highlight this whole area right here. And then as soon as I let go of the highlight button, it's going to zoom into that area. So watch what happens here. So again, to repeat, you turn the Fibonacci tool on. It just puts it on the screen. And then I'm going to take this selection tool and I'm going to highlight this area here, and it's going to zoom into it. Sometimes you have to make it get all the way over there. There we go. It's the same. It's that same chart. It's just zoomed in close, so it looks a little bit different. But so where did this stock pull back to? Exactly to that 618 retracement level. Now you could make the argument and say, well, here it pulled right back to the 50% retracement level. It still went lower. Well, again, that's why we're not getting too exact with it. Although it did move exactly right there, I don't want to get caught up in exactness. But that's kind of freaky, isn't it? That it pulled right back to that 618 retracement level. There's your zone. There's your retracement zone there. Now, because it went all the way to the 618 retracement, or 61.8%, that's the bottom of the zone. That means if I get into a trade on this thing, I might want to put a stop loss right below that 618 retracement level. Because if this stock that I buy into, and I'm not buying into it yet because I want to wait for it to go back to that buy signal, but let's say I want to be aggressive, I want to get in. It's in the zone, I want to go buy it right now. But what if I buy it and it starts to move below that 618 retracement level? Well, let me be clear. It does not mean that the stock's going to fall apart at that point and it's going to collapse. No, but it does mean that the probabilities of going higher are starting to diminish. The chances of it going higher are starting to diminish. Now, as part of a trade management plan, I might say, hey, if the chances of this thing going higher dramatically diminish, if it drops below that 618 retracement level, why not get out? Why risk losing more money when the probabilities are now not in my favor? I'm just showing you one way that you could use this. That's one way I could use that. I could use this zone as say, you know, that's where I'd want to get out, because that's where the chances of this thing going higher start to diminish. I could also use this zone as an entry area, because the stock pulled back to that 618 retracement level right here, and then you had a nice up day on, what is that, Tuesday? Nice up day on Tuesday on higher volume. I might have made an entry decision saying, hey, that's a nice bullish day after a pullback on heavier volume. I'm getting in. And I'll put my stop below that 618 retracement level or something like that. I'm just throwing this out there. Okay. Remember, there's lots of different entry. We try to make it easy in the software and buy on the buy signal, sell on the sell signal, that type of stuff. But there's lots of different ways you can manage trades if you want to put the time into it. And that might have been one way that I might have managed it. Is said, hey, I pull back to the zone. I had a nice bullish day on good volume. Now it did pull back a little bit after that, but again, as long as it doesn't dip all the way down here, I think we're still okay. It could still move a little bit flat and then start taking off. Just because you get an up day on heavy volume doesn't always mean it takes off immediately. Here you had a high volume day right here, and it was starting to look like it's taking off, and it paused the next day. I don't know why it does that, but it does that sometimes. Takes a little bit of breather after everyone got in, and then starts taking off again. By the way, you don't want to base the trade just on heavier volume, because sometimes you get heavier volume at the end of a move before it pulls back, like you did right here. You start seeing heavier volume and the stock's already run up a lot, that could be an indication that it might be time to get out or tighten up stops or take profits off the table or something like that. All right, let's look at more of these. I'm going to use the examples though of the stocks we went over today, because I want to show you that you can use this as part of the other analysis. I got a 98 strength rank. I got a nice uptrend. It's pulled back. I'm just waiting for it to go back to a buy signal, and now you could say, oh, it's made a 50% retracement, or it's hit the retracement zone. Now, by the way, to zoom back, to reset the chart again, to get it back to normal, you hit this button right here. This is the reset button right there. And it'll zoom back out again. All right, I'm going to leave the tool on there. I'm going to go to we'll work our way back. We'll go to workhorse here, WKHS. Now this is a way. Let me show you how. This is a good example of why you don't want to be too fanatical about the zone, though. Too, if I do a quick, so I'm going to measure how far this is pulled back from this trending move up right here. So I want to make sure I start my selection before this low. I usually start it somewhere in here to make sure that line lines up, that Fibonacci line, or retrace, or the trend that you're measuring. This line right here lines up with that high and this low. You'll see what I'm talking about when I select it here. So let's select that zone right here. So this is what I'm talking about. I wanted this line right here to line up with that high and that low. it's right at the 618 retracement. But it dipped below it right here. When it dipped below it right there, if I was looking at this on this day, I would have said, boy, that's not good. The stock just gapped down. It was right at the top of the zone, the 382, and it gapped right below the 618. That's not a good move. However, if you look a little bit more into it this day, what happened is that here's where it opened, but look where it closed. It closed very near that 618 retracement level and immediately got above it, and it's kind of held it right there. Now, if it drops back below it again, this thing's probably in trouble, and I probably don't want anything to do with it. But if it holds here and it goes back to that buy signal, maybe that buy signal's up in here somewhere, well, you know that it's basically retraced. From a retracement standpoint, it's retraced about as far as you would expect